Question one: when you were getting started with BRRRRs, who did you call first? Lenders, banks, portfolio lender, or somebody else? And more importantly, why did you choose them over the other options? The very first thing I would do would be to set up my contractors, set up my lenders, and make sure that my contractor understands my processes in a way that I do business. Because not all contractors are going to agree to the way that we do things, because they might be flat broke and they need to rob Peter to pay Paul, and they're not going to use my money to do that. So these are our working systems of where we operate, and if they agree to those, then we'll move on. I'll keep their number, and then as for hard money lenders, I'd have a few of those set up just to make sure if one falls through, then the other one can pick up, because you never want a deal to fall through towards the end, because it kills your reputation. Question two: when you were doing your early BRRRRs, what rates and points were you actually seeing from hard money lenders, and what should a new investor expect today? What parts of the loan terms are negotiable? Let's see here. Well, when I was doing my early BRRRRs, man, things were way different, right? So rates always jump around. They're up and they're down, back and forth. So what I am actually seeing today with hard money lenders is that's pretty common is 12 and 2. And that's probably what I would expect if you're a newer investor, like what you'll probably pay. And I would yeah, I would expect 12 and 2 for sure. And then as for parts that are negotiable, man, not really. I wouldn't try to negotiate too hard with some of these lenders. I would just do business with them, get a few under your belt, and then try to make deals from there. But when you start moving into private money, maybe someone has a 401k plan, maybe they got money in the bank, maybe they just sold a business, they want to do something with it, then you get more aggressive, 10 and 1, 9 and 1, 9 and 2, like you can start to adjust, your your strategy with them, or your terms, sorry. There is also, you can tell them that you don't want to pay any hard money interest until you're refinancing, so they'll put their hard money interest into the payoff. So there's no monthly payments going out. That's super handy and helpful, like when you're scaling. Next question: when you're buying a bird day, what's your loan to cost or percentage of the ARV you are targeting? For example, how much are you comfortable paying relative to the ARV? How much rehab budget cushion do you want, and what numbers make you immediately pass on a deal? And if you can give me one simple example, if the ARV is $150,000, look, I'm real simple. This is the way I did it. This is the way I scaled. I was investing in suburbs where houses ARV were between 150 and 180. On a three-bedroom house, I did not want to pay more than like $95,000, and that was just purchase and rehab only. I didn't factor in all the other costs. I basically created me a simple process that I operated off of. It was as simple as that. Purchase and rehab, 95,000 for a three-bedroom. For a four-bedroom, I'd go up to like 105, 110,000, and I didn't care what the ARV was. That was my buy box. That's what I stayed in. I didn't deviate from that. That's how I did it. But I was always shooting for 50 to 60% of the ARV. And that always kind of kept me pretty safe, because every now and again, man, there was just something weird that would happen, and the ARV would be a little lower than what I'd want it to be. And so that is the numbers I ran off of. That is why it's important to define your buy box and decide what it is you're absolutely looking for. So it's called doing your homework, doing some work on, like, do you want to do fully gutted houses? Do your houses need a driveway, basement, no commercial around your property? Like, how what's too big? Maybe a house has 2,500 square feet, and that's too big for you because insurance is more, right? So I try to target 1,500 square feet and less. There's certain zip codes I would target. There's different characteristics and specifics that I was looking for every single house. So you got to decide of what you're comfortable with and where you're starting, because they all have their risks. Investing in the suburbs, a little bit more crime. Outside of it, you don't have as much crime, right? So all of it works, but you got to know what your risks are and going into it, and how to mitigate that risk as much as possible. All right, question four. When it comes time to refinance, how much of your own cash should a first-time BRRRR investor expect to leave in the deal? So when you're first buying the property, if you're using hard money, at 10% of your own cash should be in it to get the deal going, unless you use gap funding, and then they'll cover the difference out of pocket. Now, this is where you gotta have, like, if you don't have much cash here, this is why you absolutely must be following a very detailed scope first system and having your trade sequence lined out very clearly, because this can stretch your cash out of pocket like a lot, right? So you have your initial cash out of pocket, because there's three things you can be talking about here of cash out of pocket. I want to make sure I clarify this. You got your cash out of pocket when you first buy the property, money down. You can cover that with gap funding. There's a cash out of pocket that you need to put up front during a renovation. So you're putting out money first, and then you're getting reimbursed through lender draws. There's a system for that. If you want more information on that, let me know down in the comments, and I'll break that down. It's going to take more breath, and I'm not sure which one, what question you're I'm not sure which question you're asking here. So the third one is the cash out of pocket whenever you are refinancing the deal. Like, how much money, when you refinance, you got to bring to the table to close it. I'll be honest, 135 BRRRRs never brought money to a closing table. If I didn't get money back, then it just broke even at a rate and term. And that is because I was very clear in my buy box and had a very tight renovation process. The 100% truth. So because the buy box was really clear, and I knew what to target the finishes, and I knew what kind of contractor to use for those kind of projects. And then my renovation followed a very specific order, right? It's a scope first system. That's what I'm teaching. So, and it's allowed me to scale into real estate at a really rapid pace. Let's see here. What is your actual experience? Were you leaving 5,000, 2,000 in some deals? You pull all your money back and others not. No, every deal I pull all my money back and paid my investors off, kept the property. And what are you seeing today, banks, regarding the seasoning? I get no seasoning period, and I'm not special privileged. That's what I look for. If a bank tells me 3, 6 month, 9 month, 1 year seasoning, I just go look for another one. And they're everywhere. There's tons of them. There's tons of banks that want your business through a DSCR program, debt service coverage ratio, and there's tons of them where they're looking at the asset income, what it produces, and based off of the income it produces and your expenses, gives you a debt service coverage ratio, and that's how they'll finance it. But the seasoning's all over the place. Again, I look for 0 days. So basically, we can buy it, rehab it, 3 weeks later, refinance it, be out the door. Pay a little bit more in percent cost, but it don't matter to me because we turn them so fast. In your experience, what blows people up? Examples: pay too much for the house. Understanding the wrong contractor, running out of cash. Dude, being over optimistic. So I think there's two parts, right? And it's the more or less method. It's what I call it in my book, and hopefully you get it. It's coming out soon. But the more or less method, more on the rehab, less on the ARV. Too many investors will say the ARV will be higher than what they think it is, and oh man, it's actually gonna be good. It's gonna be a longer part, because I've been preaching this for a long time. But investors will say that the renovation is going to be less and the ARV is going to be more. That's a terrible way to do it. Always be on the pessimist side. Like, if I think the ARV is going to be 200, I'm going to say 180. If I think the rehab is going to be 30, I'm going to say 45, right? And it's just a safe way to budget your numbers. Now, guessing is never okay. The ARV should be pretty damn close to what you're saying it's going to be. If you have comparables, that's close enough to the same street, same block, because there's certain highways you cross over and the ARVs jump a lot. So you need to be really good at determining what your ARV is. Now, when it comes to renovations, this is the part where you definitely don't want to guess, because like if you never had $50,000 in your bank account and someone tells you that you're about to do a $50,000 renovation, it sounds like a lot. Like, we could tear this mug down and rebuild it, right? So if you're guessing that renovation number, it's going to be a really, really bad deal for you. You never want to tell your contractor, I got a $50,000 budget, or that's going to screw you. Because you think the contractor, if he can do it for 40, he's actually going to tell you he can do it for 40? No, he's going to say he can do it for 50 and do it for 50, right? So this is so important that whenever you're doing this, you use a scope first system. You build out your scope of work, you get 3 estimates. Scope first, number second, negotiate last. So you're going to do your homework, understand where you're buying and what you're buying. You're going to know the ARVs really well, what house is selling for. You're going to be really confident in this, right? And you're not going to be stupid like, oh, there was one comp that sold for 300 and the other ones were 180 and 200. No, go be the pessimist on yourself, because this is your business. Be safe here, because you're dealing with tens of thousands of dollars, and you got that on the line, right? This is your family's future that you're dealing with, right? ARV always say less. If you got strong comps, 230, 235, 233, 236, 237, you're safe on that. Still go lower. 225 on ARV. Don't care. That's the way I do it. It's the way the process works. And I'll walk from a deal because, again, it's thousands of dollars that you got on the line. So a little less on ARV. Once I do my scope, once I get my 3 contractors that come in and bid those, bid the scope, then I negotiate the house price. I still have a contingency in my renovation. So if my renovation goes over, the contingency covers it. But at least my scope of work is accurate enough that it will avoid scope creep from the contractor, keep the contractor on track, on time, on budget, and it also gives me a roadmap to follow that when I'm dealing with my lenders, they're reimbursing me money back, right? And that's kind of what I was hinting at on the other one, on the question above. So for sure, renovations and ARV can absolutely kill a deal. Now, here's the other thing I want you to understand. This is so important. You also, when you're doing the BRRRR, you need to understand rental rates, because you can't just make up a rent number and be like, oh, this house is so beautiful, it's going to rent for $2,000 a month. Don't be ignorant. Study rents. Like there's plenty of rent. Just go to Google and say, give me rent comparables in areas like Rent Check. There's a whole bunch of them. And find out what houses rent for in your area. Say the average is $1,500 a month for a 3-bedroom. That's the number you want to use. So you need to make sure that your PITI, your mortgage payment, is less than $1,500. And ideally, you try to target $500 a month in cash flow. Some people say it's really hard, and it can be. So at least target $300 at minimum, right? There's a whole lot I could talk about right here on this. But the reason why I'm telling you this is because, one, that is what the DSCR program looks at. They want to make sure when they lend you money that you're actually profitable. And you must understand this, because if you go to refinance thinking the property's $200,000, you're going to get 75% loan to value. They're going to cut a check for $150,000. If you're into that project for $160,000, you're $10,000 out of pocket. So it doesn't matter what the ARV is. What matters is what your rent comparables is. So that's why my buy box is, for a 3-bedroom I'll pay $95,000. For a 4-bedroom I'll pay $100 to $105,000, and that's just purchase and rehab only, right? And then we get in there, and once we're done with the project at those prices, we refinance it, and I've always been safe with those numbers. So you got to keep in mind that even if you can pull out a lot more money on the refinance, is it necessarily the right thing to do? No, most likely not, because you want to keep that PIT as low as you can so you have more money coming in, so you don't have more month and not enough money, right? So, question 6. How much cash reserves would you want a first-time BRRRR investor to have? 20,000 for the Midwest, because that can drastically change. Obviously, if you're in California, that's probably $100,000, right? And depending on which part of California you're in. But here in the Midwest, anytime I consult with people, I say $20,000. You have $20,000 in your pocket. And that doesn't mean you can now go out and do $1 million project, because I was looking at a deal the other day, and it was going to be $60,000 out of pocket. That was to cover the points. I'd use a different lender because all our private money was spent, and I needed another lender to fund a deal. It was going to be a home run deal, 6-figure profit. But so was I willing to put up that money in order to have a good return? I mean, yes, absolutely. But for you, you need to be targeting probably $20,000 in your bank account, and ARV is $250,000 and less. Okay. Now, if you go pick up some private money, and they don't require you to put any money down, and they're actually giving you money at the closing of the renovation loan, sweet deal. And you can scale that way, right? There's options. That's what I'm telling you. But yes, you definitely want to have a good reserve of $20,000 to get going in the business. And then let's see, what would make you sleep well at night? For example, 3 months of mortgage payments, 6 months, $10,000, $25,000, enough to cover a major repair, enough to cover vacancies. Man, this is all good stuff. This is beautiful questions. When it comes to how much capital you should keep in repairs, well, when you did the renovation, your 5 majors should be good. That's all in our Scope First community, in our school.com/Scope First community, where I put the 5 majors in there, and then all the spreadsheets to track that. But your 5 mechanicals should be good. Those are your 5 majors should be good, right? Once your 5 majors are good, you can take that off the list. Typically, then you got the sewer line underneath, and most people don't get those. They don't get those snaked. So you want to get home and serve insurance on that, which is like $19 a month. And if you didn't replace the furnace or something like that, you better go get you a warranty home warranty that will cover any repairs on that, so you don't have to pay any more money out of pocket on the maintenance. But maintenance will absolutely eat you alive. That's what I was saying. Like, you want to target at least $500 a month in cash flow if you can. It can be done, especially if you do some creative financing deals. If you keep your rehabs really low, but also don't jeopardize your ARV, it can 100% be done. Happy to share that with you. Just ask me in the comments. It's just a much longer conversation to know. I don't know what it is exactly you want, and once you do know, I can elaborate on that some more. So for reserves, I mean, say you want 6 months of reserves in your bank account for everything that you do. When you're scaling, that can be very difficult. There was times where I didn't even have a month of the mortgage payments in my bank account, and we're heading into the next month really quickly. So, for me, a couple times a year, things get tight, but we were very aggressive. We scale quick, right? About 100 doors in less than 3 years. So it came with its fair share of challenges, because you're gonna have vacancies, turnovers, people doing dumb things, and you're gonna you got to fork it up, right? So if you're listening to this strategy, and I understand, like, we all want to get rich, we want a nice car, we want to go on the vacation, we want to do all that stuff. But here's the deal: to scale really is going to take a part of your soul you'll never get back. But there is a good strategy, and that is buying one property a year for the next 15 years and getting a 15-year note on it. And after 15 years, you sell one property a year for 15 years, and then you just capitalize on that money. It's a very beautiful model. Now do the math. Maybe you buy two properties a year. 15-year notes on both of them, and then in 15 years you start selling off two properties a year. You're now making anywhere from $300,000 to $400,000 a year just by selling off a couple properties, right? So you don't have to scale to get wealthy quickly, right? Like, you can definitely be very consistent every year, turnover. I mean, think about it. Even if you did 5 houses a year, and you sell 5 in 15 years, dude, you're making $1 million a year. Easy money, right? For 15 years, you're gonna bring in $15 million. So many different strategies. I would say on your first one, just make sure you're part of our school.com/scope first community, and we will help you see your first one through, right? Community is free. This it is right now, and we want to help you. We want to help you grow. The business has been good to me, and so this is our chance of giving back. I think I answered all your questions, and if there's something I'm missing, or if that open up more doors to more questions, I'm happy to answer those, and I truly answer those to the best of my ability. There's a few things in there I wanted to elaborate on, so if you're watching this, make sure you have your notes, and you can tell me where we could elaborate and give you some more information on, because I want to see you be successful. Anyways, I hope that helps.